In the winter of 1980, two brothers from Texas quietly accumulated over half of the world's tradable supply of a single precious metal. They didn't do it with an army, and they didn't do it with a hostile corporate takeover. They did it by exploiting the mechanics of the futures market. By January of that year, the global economy was literally one phone call away from collapse. Major Wall Street brokerages were facing immediate bankruptcy, and the United States government was forced to intervene to stop an absolute financial meltdown. This is the story of Silver Thursday, and the terrifying reality of what happens when you try to back Wall Street into a corner. Welcome to Case 011. Today, we open the file on the Silver Corner. We will investigate how extreme leverage, immense oil wealth, and a deep distrust of fiat currency led to one of the most audacious financial maneuvers in human history. To understand the crime, or, depending on who you ask, the brilliant trade, you have to understand the men who orchestrated it. Nelson Bunker Hunt and William Herbert Hunt were not your average retail traders. They were the heirs to the colossal fortune of H.L. Hunt, an eccentric Texas oil tycoon who was once considered the wealthiest man on earth. The Hunt brothers inherited billions, but they also inherited their father's deep, almost paranoid distrust of the government and paper money. In the 1970s, that paranoia seemed entirely justified. The United States was abandoning the gold standard. The printing presses were running hot to pay for the Vietnam War and massive social programs. Inflation was skyrocketing into the double digits. The value of the US dollar was rotting away right in front of them. The brothers looked at the financial landscape and made a simple, unshakable calculation. Paper money was a dying illusion. The only way to preserve their dynasty was to convert their paper wealth into hard, physical assets. You can't print oil, you can't print land, and you can't print precious metals. Gold was the obvious choice, but at the time, it was illegal for private U.S. citizens to hold massive quantities of gold bullion. So, they looked to the next best thing. A metal that was not only a store of value but an essential industrial component used in photography, electronics, and manufacturing. They looked at silver. In the early 1970s, silver was trading at around $1.50 an ounce. The Hunt brothers started buying. But they didn't just buy a few bars to lock in a safe. They began to absorb the global supply with a terrifying, methodical aggression. If you want to buy $1 billion worth of a physical asset, you usually need $1 billion in cash. But Wall Street doesn't operate on cash. It operates on leverage. The Hunts utilized the commodities futures market. A futures contract is essentially an agreement to buy a specific amount of a commodity at a specific price on a specific date in the future. In the commodity markets, you don't have to put up the entire value of the contract. You only have to put up a small percentage, known as the margin. For the Hunts, this meant they could control tens of millions of ounces of silver by only putting down a fraction of the actual cost. They were using their vast oil wealth as collateral to borrow heavily from Wall Street banks, taking out massive margin loans to buy more and more paper silver contracts. As they bought, the sheer volume of their purchasing power began to drive the price up, and as the price went up, the value of their existing contracts skyrocketed. They used those new, unrealized profits as collateral to borrow even more money to buy even more contracts. It was an unstoppable, upward spiraling feedback loop of extreme leverage. By 1979, they had been joined by a syndicate of wealthy Saudi investors. Together, they controlled an estimated 100 million ounces of physical silver and futures contracts for billions more. But the Hunts didn't just want paper profits. They were about to do something that broke the fundamental illusion of Wall Street. They were going to demand the physical metal. But how do you take delivery of 100 million ounces of silver? The answer involves unmarked cargo planes, heavily armed guards, and secret Swiss vaults. But we will get to those mechanics shortly. The commodities exchange has a dirty little secret. It is a paper market. For every 1 ounce of actual physical gold or silver sitting in a registered vault, there are dozens, sometimes hundreds, of paper contracts trading hands on the floor. The system relies on a gentleman's agreement. Speculators trade the paper for profit, and they almost never ask for the physical delivery when the contract expires. They simply roll the contract over or take the cash settlement. The Hunt brothers refused the cash. When their contracts expired, they demanded the physical silver. This sent a shockwave of sheer terror through the commodity exchange, known as the COMEX, and the Chicago Board of Trade. The traders who had sold the contracts to the Hunts, the shorts, were suddenly legally obligated to deliver millions of ounces of silver that simply did not exist in the exchange vaults. To satisfy the Hunts, the shorts had to scramble into the open market and buy whatever physical silver they could find, at whatever price the market demanded. This massive, desperate buying pressure poured gasoline on the fire. Meanwhile, the Hunts were hiring fleets of unmarked, armored Boeing 7007 cargo planes. In the dead of night, they were flying thousands of heavy 80-pound silver bars out of the United States, transporting them to highly secure, secret bank vaults in Switzerland. They were physically draining the lifeblood out of the American commodities market. The price of silver went parabolic. From $6 an ounce in early 1979, it exploded to $10, then $20, then $30. The Hunts had effectively cornered a global market. They had the banks and the exchanges trapped in a mathematical vice. But the brothers forgot one crucial, terrifying detail about the financial system. It is a detail about centralized power that would ultimately cost them billions of dollars in a single afternoon. We will look at that fatal oversight in just a moment. By January of 1980, the global silver market had descended into absolute madness. The price hit an astonishing $50.40 an ounce. The economic ripple effects were immediate and chaotic. The photography industry, which relied heavily on silver for film development, was paralyzed. The iconic jeweler Tiffany & Company took out a full-page advertisement in the New York Times, publicly condemning the Hunt brothers, stating, "We think it is unconscionable for anyone to hoard several billion, yes, $1 billion worth of silver, and thus drive the price up so high that others must pay artificially high prices for articles made of silver." A mania gripped the general public. Ordinary citizens realized the metal sitting in their dining rooms was suddenly worth a fortune. People lined up for blocks outside of pawn shops and coin dealers, desperately selling off their family heirlooms, silver tea sets, and commemorative coins just to melt them down for the raw metal value. On paper, Nelson Bunker Hunt and William Herbert Hunt were making billions. But the Wall Street brokerages that had lent them the money and the traders who were short the market were facing total annihilation. If the price went any higher, the major clearinghouses would default. The COMEX would go bankrupt. And because the financial system is deeply interconnected, the failure of the commodities exchange threatened to drag the major Wall Street banks down with it. The system was breaking. And when the system is about to break, the people who run it do not simply surrender. They change the rules of the game. The Hunt brothers believed they were playing a fair game of capitalism. They had bought the contracts legally, and they were demanding delivery legally. But they underestimated the power of the House. The board of directors of the COMEX was not made up of impartial judges. The board was made up of the very same Wall Street insiders and financial institutions that were currently losing billions of dollars to the Hunt brothers. The shorts were running the casino. On January 7, 1980, the COMEX took emergency action. They implemented Silver Rule 7. Overnight, the exchange placed severe restrictions on purchasing silver on margin. But they didn't stop there. A few weeks later, they did the unthinkable. The exchange announced that it was suspending the trading of silver entirely, with one massive exception. You could no longer buy silver. You were only allowed to issue liquidation orders. You could only sell. They explicitly outlawed the Hunt brothers from buying any more contracts. When you make it illegal to buy an asset and only allow people to sell, the price can only go in one direction. The price of silver instantly began to collapse. It plummeted from $50 down to $30, and then down into the 20s. As the price crashed, the vicious margin loop that had built the Hunt empire suddenly reversed. The Wall Street banks that had lent the Hunts billions of dollars looked at the crashing value of their silver collateral and issued massive margin calls. They demanded that the brothers deposit hundreds of millions of dollars in cash immediately to cover the dropping value of their accounts. But the Hunts didn't have the cash. Their wealth was tied up in the silver, and the silver was crashing. Thursday, March 27, 1980, will forever be known in financial history as Silver Thursday. On that morning, the Hunt brothers failed to meet a $100 million margin call. Panic swept through Wall Street. The brothers were heavily indebted to several major brokerages, including Bache, Halsey, Stewart, Shields. If the Hunts defaulted, Bache would collapse, potentially triggering a domino effect that would crash the entire United States financial system. To prevent a global economic catastrophe, a consortium of major U.S. banks, with the quiet blessing of the Federal Reserve, was forced to step in. They quickly organized a massive $1.1 billion bailout loan for the Hunt brothers. But the loan wasn't to save the Hunts, it was to save Wall Street. The banks seized the brothers' remaining assets, their oil fields, their cattle, their real estate, and their silver, and slowly liquidated them to pay off the massive debts. The Hunt brothers lost billions. They were eventually forced into personal bankruptcy and convicted of civil charges for manipulating the market. They tried to break the bank, and the bank broke them. The silver corner is the ultimate parable of counterparty risk and the illusion of control. Today, any retail trader logging into a brokerage account, charting futures, or trading on margin needs to understand the fundamental lesson of 1980. When you trade with massive leverage, you are not just betting on the direction of an asset. You are betting that the system itself will remain stable. The Hunts believed that because they held the physical asset, they held the ultimate power. But they forgot that the arena they were fighting in was owned, operated, and regulated by their opponents. Financial markets are not natural phenomenons governed by the laws of physics. They are man-made constructs. And when a centralized exchange, a clearinghouse, or a government is backed into a corner and facing total destruction, they will not quietly accept defeat and hand you the keys to the kingdom. They will simply change the locks. In the world of extreme capital, the house doesn't just have an edge. The house makes the rules. And if you threaten to break the house will change the rules overnight to ensure its own survival. This closes Case File 011.